ready to start here to go live. There we go. Okay, you're live.
Okay. I'm live?
It will be. It'll come up.
I see.
Give it a few seconds. To them. Okay, go.
I'm seeing an image of me from a few minutes ago, I think.
Yes. So there will be that delay.
Okay.
Also, I want to start with saying just kind of do a general explanation and welcome because this will be a video later.
Did you say that?
So they're going to hear me.
It's all right. I'm waiting for 8 for 8 p.m. to really get going, but Welcome everyone to this our second live stream, and I wanted to update people on what we were thinking about the markets, and I wanted to welcome some new people and just invite in the world to hi Peter to get a handle on what we're trying to do here, which is educate and inform about trends in markets based on time cycles that we have been unfolding and discovering. And we have been able to have quite a bit of success in terms of looking at the shorter term trends. But tonight I wanted to add a little bit more information. And of course, I'm open and welcoming questions, and if possible, I can answer some of them, to see what's coming in the bigger picture, because it turns out there is a very, very rare cycle event that's going to be happening with a high probability. You never know for sure, but for a high likelihood that later this year we could see a market crash. And that's something I haven't been talked about before. I've been bullish, this 2023 on the stock market and the S&P. We were bearish last year, and we're still. The implication was we're in a very long-term secular bear market, but in 2023 we would have a bounce, and it would be fairly large, and it hasn't really happened yet either. So I wanted to modify, not change, because most of what we said is still going to be the case. But after September 1st, after Labor Day this year, between Labor Day and December, there's a really good chance that the market's going to fall apart for a few months. And I'll discuss the evidence with you about that, but I wanted to put that out there now because, we're still in March and we haven't had a situation occur yet where, where there's a real need for worrying, and I'm not concerned about the market in the short term. Our forecast had been that we're expecting a rally starting in June, and a fairly significant rally starting in June that could go all the way through until October, and possibly longer. And that's still true. We're still expecting a big move up into the fourth quarter. But we found another cycle. It's 94 years, and it has been repeating fairly well, not day by day, but on a weekly chart you can see it. And for those who do the arithmetic, 94 years from 1929.
1929?
Yeah, the 1929 market is repeating, and it's not identical. And the crash in 1929 may not repeat with the level of vehemence that it had back then. But nevertheless, we are expecting a big decline in the fourth quarter, which would mirror the timing of that market and be more severe than most people are looking for at the time that it does happen. Right now, everybody's bearish, People are worried and they're thinking the market's going to die and all this stuff. And what'll probably happen is exactly the opposite in the short term. We have a little more decline potentially until the end of March, into April a little bit. And then I'm expecting, I'll show you the chart pattern in a minute. Expecting a high in May, a low in June, and a sharp rally up into September. So by the time September comes, everybody's going to be happy and bullish, thinking the bear market is over and the game is a new life has started. But the unfortunate part about this scenario is it's exactly what happened in 1929. And it's exactly what happened in 1987, 36 years ago, where we had obviously the most dramatic, well-known crash, which everybody knows about. And the additional feature is that there's also a 130-year cycle in the stock market, which I discovered some time ago. And 130 years ago would be the year 1893, 1923 minus 130. Turns out in 1893, guess what? You had a massive crash and the beginning of what was called the Great Depression. Until the 1920s, the biggest depression that we ever had, the Great Depression, was labeled from 1893 to 1897. So we have two occurrences. One is a 130-year cycle, the other is a 94-year cycle, both of which come in 2023, and both of which are behaving the same way they did back then. And I'm going to show you a chart of the 1929 market back for, it's a weekly chart back a few years. You can put that one up. And in that chart, you can see the labeling of the weekly cycle lettered. I put letters A, B, C, D, E, F, G. And I put them on the upper chart and also on the lower chart. Is it up yet? It's up. You guys can see it. All right. So the bottom line is, for the last 3 years, including the 2020 big decline, and we had a similar thing in 1926, and then it was stronger in 1920, in the 20s. It was a stronger market than we had. We had a very strong market, but that one was even stronger. But the pivots, the high and low points, major weekly change points, they lined up exactly with this market, and they're still in line with this market. And even now, if you look at the lettering that I'm using, there's a, let's see where we are. Yeah, just trying to find it. Yeah, where that very dark vertical pink line is, that's now. That's roughly March of 2023, lining up with March of 1929. And prior to that, there was a high in February. There was a high back then in December. We had a high in December, high in February. We came down. And if it does it exactly the same way, which it may not, but if it does anything near what it did then, it makes a low in March or early April, a high early May, a low in June, and then it takes off strongly until September, which is, interestingly enough, in line with what we were forecasting anyway. It's exactly what we were forecasting based upon the 1935 market, the 1993 market, using multiples of 30 years ago, the 88-year cycle, 29.5 times 3. So the only variation here is that you have a humongo decline starting September. It waits until October, and then it collapses until November. Then there's another little bounce and a decline that could go into January. So I wanted to give people this heads up. I wanted to let people know that all the bad news that's been bounding about, all the Elliott wave vatiers looking for a third of a third, looking for the bear market, to continue immediately and all this, I don't think the pattern is going to do it that way. I think what's going to happen is that we have this consolidation period right now, just as we had March, April, May of 1929. And then we have a decent, giant, possibly new high for the year, even taking out last year's high. looking really bullish, and then, watch out below. Now, how big will the decline be? There are differences between 130 years ago and 94 years ago, insofar as some of the phasing of the cycles is different. The 30-year cycle is actually still up, where it was down in 1929. It was also down in 1893. So one of the components which could cause a dramatic crash is missing. It's not going to cooperate. So the decline this time is not likely to be as dramatic, as intense, but it is potentially big enough to, people could lose quite a bit of money if they don't know about it. And then the interesting thing would be what happens after that is, in 1929, you had a rally for 5 months into April of 1930. And the market, obviously, we had 1930, 31 into 32, had the biggest correction in the history of the stock market. Don't believe that will happen again. However, it doesn't bode well for 2024 because the timing will probably be similar. There will probably be a high around April and a low late in the year in 2024, and it's conceivable continued weakness perhaps after 2024 ends. So the pattern is worth taking seriously because we had a high in 1929, a low in 32. You had a high in 1893, which would line up with 2023, a low in 1897, 4 years later, which could mean that we have a very sustained trend, at least in 2024, and we could have another dip that could go on as late as 2027 before the whole thing's over. It doesn't mean it's going to go down every year, may not. It may have a bounce in 2025, a bounce in 2026, and then turn back down in 2026, 2027, So it's not a straight shoot down. We're not going to go to zero. But starting in September of this year, you have to start being a little bit concerned about what might be coming. And that was important to note. I want to put up the other couple of charts. I want to put up the 1987. First of all, let's look at 1929 on a daily chart, mirroring what we've been seeing in our own market this year. And when that one comes up, we'll discuss it a little bit. No, the two of them together is what you have now. It's just another one. This is 1929. There we go. No, that's still the same one. There it is. I got it. Okay. So this one, this is 1929. You see how there's an arrow. I don't know if you can see it. You may have to be able to blow it up a little. But there's a high February 1st and a consolidation period that goes on for a few months, February, and then there's another high, looks like what, March 18th, and there's a low March 31st, a high May 9th, a low May 31st. We're in that phase now. That's what's going on in our market now. We had the high in February. We had a sharp break today on the Fed announcement, and expecting a little bit further decline into late March or early April. Potentially April 3rd or 4th is the next low point. Then a rally up into May was projected, and a decline into June. It could be early June. And then look at 1929. You had that big rally from the end of May all the way up until September. Had a second high in October. It turned out to be October 14th. And then the crash, October 14th until November 14th, November 13th. And then a 5-month rally. It came halfway back up into 2030. And that was the essence of what we were looking for. So that pattern is repeating fairly closely what's happening now. And our expectations about the time frame, where until June, we're looking for a choppy market with swings up and swings down, but in a range. We're between 4,200 on the upside possibly 35, 3,600 on the downside as a controlling influence as a support level. And then we could break above the 4,200 area and go up significantly higher by September. And the timing is the key, whether it does it exactly the same way or not. Peter says, why is October when a lot of bad things happen? Okay. The reason actually is astrological. It turns out if you look at the solar cycle in Vedic astrology, it turns out that the sun is in its maximum debilitation, its weakest sign, between October 15th and November 15th. And so the market tends to weaken starting September and October. And the strongest sign for the solar cycle is in April into May. And it turns out that the market tends to rally from October into May, and it tends to have weakness. Doesn't always go down, but at least the strength of the market has been distributed unequally throughout the last 50 years, where you make almost all of your money if you go long in October and get out in May. They even have coined the phrase, sell in May and walk away. You're wasting your time doing anything until October, because most likely the market isn't going to perform very well. And so that's the reason for it. It's an astrological kind of a thing. It's ironic that the US presidential elections are always in the first or second week of November. And it turns out that's when we get our presidents each time, when the sun is weak. And it does kind of make sense, because it kind of implies that the leader of the country is sensitive to public opinion. Like if you have a tyrannical king or something like that, their egos are so powerful, and they don't think about having to get the approval of the electorate to get elected. Whereas in the United States, George Washington refused the title of king. He refused to imitate the British, which he considered to be a horrendous situation, to have a potentially tyrannical leader as a king. And thus the democratic system that we designed and that ultimately we've been living is connected in some way to the fact that the elections take place in November, early when the sun is weak. So that's kind of the interesting thing. So the 1929 pattern is repeating this year so far pretty closely. Let's take a look at 1987, 36 years ago. And it turns out, 1929 is 94 years ago. And if you look at 130-year cycle, it turns out that there was also 130 years before 1929 is 1799. Guess what happened in 1799? You also had a massive crash and depression. It turned out it was in Germany that time. The United States hadn't developed its economy strongly enough. So anyway, the bottom line of the whole thing is that the 1987 pattern is the same again. You had a high in February, a high in March, a low in late March, a high in early May, a low in late May, early June. It shot up exactly the same way it did in 1929. We had a high August 25th and another high on October 5. And there you go, and the crash came. So we're looking at October this year being kind of nasty. And it probably isn't going to get particularly good until after the end of the year, for a few months into April of 2024. Okay, that's the main point, that I wanted to get across here. And it isn't unlikely. Nobody can guarantee it's for sure, and I'm certainly not trying to create panic. But it's better to have that thought that it's a possibility. And if this pattern continues to develop, if it continues to unfold according to this roadmap, then the probabilities get even higher that the last quarter of this year could be dramatically bearish. Okay, so that's the way to gauge it. I wouldn't get out of our long positions now. I would be actually looking to buy probably if the pattern is stable, meaning it doesn't go down too much into late May. Then it's probably repeating, and then there's probably going to be a rally in June and July, and we have an opportunity to make money on the upside. But this is we're talking March. I'm talking 6 months from now. That if indeed this does happen, and it's potentially dangerous, and it also could be very profitable if you go short. So that was the main point. Okay. Do we have any other questions? Anybody have anything they want to know about this or other things in the markets? You could just type into your chat.
What about matrix channels?
Okay.
In the meantime.
Well, we also have, I wanted to point out a few things that we're doing that let you know what's available to you guys. We have a website now, and you're going to put the website in? Yeah. The website is going to have more and more content. We're building it. And on the website right now, there's what we call, it's tradeforecastmastery.com. On the website, we have additional features which will be included that are, I think, unique. I'm proud to say a lot of the stuff I invented. So the good news is that there's a thing called Matrix Channels, which is available. You just go to the website and you can find it. And you'll find that it gives a set of lines of force that are located each week in the S&P that are lively and that are useful for understanding what the market support and resistance levels are for that week. And they're fairly precise. So when those channels are broken, you need to at least recognize there's a possibility something is going on. And they often do stop the market. They often do create the resistance and support levels that are intraday for intraday traders and for others who are looking for more meaningful high and low points. They do show up on the matrix channels. That's available. Okay. We also have various courses that we provide. One course is on the Ichimoku cloud technique, which is a very powerful indicator. It's been known for 60 years or so. And we improved it. We created another set of settings which allow it to work more effectively than the traditional settings do on the daily charts of most commodities and stocks. And that's available also on the website. And of course, the other thing is we're always talking about forecasting, and there will be additional information about forecasting, and at some point some articles about forecasting that we'll add. And of course, our trade forecasting program, which is available to everybody. And that's something we've done a few times now, and it's been very well received, and I'm very proud of the results. The students have come away with quite a bit of knowledge, and they're using it, and they're making money with it. So I'm really, how does it have a 3-month cycle? How does gold have 3-month cycles? Okay, some good questions. All right, so anyway, the point is we're going to be giving our next class, our forecasting class, starting this Sunday. It's a 3-month program. The first 4 weeks are classes, 2 hours each week, and then the next 9 weeks we do a 1-hour clinic, generally on Saturday mornings, U.S. time, and they've been very helpful to integrate the more abstract levels of knowledge, in which you should be able to see the reasoning why this 94-year cycle is there, why the 130-year cycle is there. You notice there's a 36-year interval between 94 and 130. And here in 1987, it's 36 years from now. So we have a double beat, as it were. You have 1893, 1929 crashes, and now 1987 and potentially 2023 could be another mess, kind of thing. Okay, so the questions. Does gold have a 3-month cycle? The answer is gold has a 3-month cycle, but no cycle that's that short is going to continue to be there every time, okay? And the reason is the 3-month cycle is a harmonic of a 6 and a 12 and an 18-month rhythm. The 18-month is part of an 18-year rhythm. So ultimately, you're going to find that they seem to flip. Sometimes they're high to high to high to high, and then it flips, becomes a low. What you need to do is find the sequence of 3-month cycles that's repeating 18 years earlier. And then you have a high reliability of a particular occurrence. Now, of course, if it goes into the 3-month point and it's rallying into it, then there's a good chance you'll find resistance in time at that 3-month point. But it's not a guarantee that you'll have a 3-month rhythm every time. And gold does have a 3-month interval in it, yes. Nikhil, can you explain your matrix channel chart on March 20? Okay, we're going to get it and see if we can talk about it. I'll come back to that. She's putting it up. All right. What charting program do we need to use for your courses? Well, I use TradeStation, but a lot of people use TradingView. You can use any number of different programs, but as long as you're able to have a cycle finder, we can locate cycles and scan and move the cycle finder left and right so that you can move it along and see if it, how it's fitting into the data. That's all that you really need. Any of the more modern platforms, particularly those that are made for futures trading, they usually have all the indicators and all the things that you'll need. We have additionally, you might want to have the MACD. Oh, there we go. Yeah. You see how this is this week's matrix channels. That blue line underneath the market, which is at about 39.20, and the larger, there's another blue line at the top. Those two are both parallel to each other. They're both the same energy force. You're welcome, Roy. The in-between ones are also there. So the darker ones are the ones that are stronger, the dark red and they're going to continue to be there next week as well. They're not going to go away. Some of the others are moving at an angle or a diagonal, and they're all real. So at this point, the support area is still the same. You have 2 or 3 lines that are down there in the 39.20 area and 38.50 area, and they'll be continuing to extend into the future. The one that's moving up very quickly, that's a trigger line. That's kind of like it's a shorter term cycle that's being measured, and it tends to be important, but more intraday, and it doesn't necessarily have the longevity, and the support level won't hold as long, but it's also very meaningful, particularly when it crosses over another line. It's like two levels of time. 2 cycles are kind of conforming to each other. All right. Any other questions here? Well, the matrix is, these are unmanifest forces. They're not trend lines. They're not Gann lines. They're not generated by the data itself. They're not generated by anything that happens in real life. These things are unmanifest, meaning they are there whether the market is there or not. They are just at those price levels, and they represent quantum levels of energy that are in the market prior to the market getting to them. So they're very invincible, they're very stable entities that you can rely upon having a meaning. Now, you can break through them. If the market's very weak, it'll break through them. But even when it does, it tends to retest before it's able to go down. Sometimes the first time it hits it, it'll bounce, and take weeks before it can break. Um, you can see how the red line and the dark red line, it was the high of this last few days, and the dark blue line was the high of the low of the last few days. Even now, we didn't get down to it again. So it's likely that you can use those for support and resistance. If you have other things indicating to buy or sell, you can use this as an additional support, an additional piece of data that allows you to buy and sell as well. Let's see. I see the S&P has 1-month swing cycles also. That is true. Yeah, well, see, the monthly cycle, I mean, everybody knows about the moon. Lines are available on the website, right? The moon cycle is very important, and everybody knows that there's a 28-day rhythm in some ways in nature. It's a natural thing. It turns out, as was discovered on, I think Gann knew this, but it was discovered most recently about 25 years ago, that there's a 4-month lunar cycle. Not 4 calendar months, but 29.5 day intervals where you have new moon to new moon, full moon to full moon is 29.5 days. 4 of those, okay, which is like 118 days, calendar days. That's an important cycle in the market. It tends to repeat according to that interval. And in this case, you see the market has been doing it upside down. It can also do that. So you could have 4 months ago repeating in the present market, but doing it upside down. And then what it did 8 months ago, it's doing right side up. So you can use the 4-month interval and the 8-month interval when they agree with each other to find potential pivot points going forward. And it's a short-term useful tool that's available in the stock market, but it's also in the variety of commodities markets. You can do it in gold and such. The bottom line is that there are laws of nature, there are natural laws that are operating in the markets that are independent of the markets. They affect humans, they affect trees, they affect the weather. It's just natural. It's nature. But they're measurable. And when you start measuring the rhythms of these natural phenomena, and then you begin to realize they also affect the markets, they can become a tool to add value to and to allow you to make money in the markets. And that's what we're doing, basically. None of the things that I'm using, I made up. Okay, thank you, Nikhil. And the reality is, none of the things that I'm doing, I made up. I've learned them either from Jerry Boehmring or things that I've had insights about that other people have talked about, and maybe I extended or expanded on some of those things. Also, being a mathematician, I find numbers very attractive. I find ways of, adding numerical descriptions and formulas to things that other people kind of intuit. And that's part of the reason now that we're developing a new product, which hasn't yet come out, which is coming out soon. We have some new trading systems that they're not new. I've had them for many years, but we're going to start selling the signals of those systems. We have one, which I call the 12-wave model on the S&P, and I've been sending the signals to people who are interested. And they're coming, it's not a frequent, it's not a intraday type thing. It's not that active. It averages about 1 trade every 2 weeks. Sometimes they take a month, sometimes they take 3 or 4 days. But it's easy for us to send the information because we just send it by email when it happens. But now we're creating an actual automated setup where you can get intraday systems as well, more dynamic systems that have multiple trades a day or have multiple trades a week, emailed and texted to you. And they will be available as soon as we get the technology perfect, as soon as we're sure. And also they can be automated so that you don't have to trade them. You can get your they work on TradeStation at the moment. You can get a TradeStation and we'll send you the ELD, which is the system. You put it on your computer. You can turn it on so that it trades without you. Just the signals will come in and it'll actually make the trades, take the money out of your account and do the trades. I mean, that's yes, for day traders, you can automate these signals. So if you don't want to do them, you can also trade them manually. How many trades per year do you tend to make and holding time? So the system that we have right now, which is roughly 2 trades a month, I have another one which we're going to be putting out that does about 3 trades a week. So that's roughly 150 trades a year, and it's on paper, you know, some ridiculously it makes a tremendous amount of money, but you also have to get used to understanding it. And we'll have the statistics on each of these systems on the website. We'll show the drawdown and the maximum number of winners and losers, and you'll get a feel for it. And I think it's something that will make a lot of traders much more capable of, even if they don't use the system alone, they could use it along with whatever else they're doing to get additional probabilities. Because one of the main things with trading is you need to know your odds. And most people don't know their odds because they don't really know the odds that their system will win. They don't know how many trades will win, how many trades will lose. But these systems have been back-tested for 20, 30, 50 years. And so in the last 2,000 trades, it's had 72% winners or 63% winners or whatever, or maybe in some cases 92% winners. And so you can do the money management much more effectively when you know what your odds are, what the risk is. That's a way to control your trading and to make the trading much more orderly. Any good poker player knows he knows what the odds are when you have a certain number of cards out there. What's the likelihood of winning with the hand that he has? And that's what we're trying to do, is give more professional tools available to the public so that they can compete with the professionals who have all these tools available to them. Now, fortunately, they don't have the forecasting. And I know that because I give advice to the professional guys because they can't forecast. Many of them can't. And so the forecasting that we teach is actually a very high level of knowledge, and it's something that isn't really, you can't get it.
So what about and why you use one that has users but makes the most money?
Okay, so there's a question about the Ikimoku technique and the automated. Oh yeah, we also have an Ikimoku automated system that's day trading. It makes a lot of signals. I was testing it today and had 17 signals. So, but I was interested in putting it out there because it's also an example of how you don't have to win a high percentage of your trades in order to make a lot of money. But you do need to control the risk. If you can have a system that makes 30% winners, and but the winners are 5 times as big as the losers, then the drawdown will be reasonably small. You just have to get used to the idea that you could easily have a loss. And then, Richard Dennis used the expression, "I welcome the losses," because the statistics are set up in such a way. After a certain number of losses, you have a very high probability of a win. So let's see. Can you explain the 12-wave model? Go short on today, March 17, per contract. Okay. So this is okay. To understand the 12-wave model, basically, it's going to buy and sell on the close of some day. In this most recent trade, it went short. It went short on March 17, and it has a very large stop because the profits are very large also. So it's not a day trading kind of thing, and it can be done in a non-leveraged format if you want. If you don't want to use futures, you can use SPY and non-leveraged entities that trade the market. But it basically does an entry on the close of the day in question, and we use roughly a 355 S&P point stop, which is a big one, but that allows it to make the maximum amount of money. I could have used the tighter stop, and you get stopped out more often, and the losses would be smaller, but it also cuts off a number of big winners. So it turned out the return to risk ratio is best if you did it that way. The $18,600 profit objective, if it should happen that you get 18,000 profit before the trade ends, then you get out before the time point would indicate the new trade. So the model is based on time only, okay? There are 12 waves that are added together, and when you have 7 are up or 7 are down, so when 7 or more turn up, the cycles turn up, then it goes long. When 7 or more are turning down, the system goes short on the close of that day. But the trade will, let's say, go on from March 17th to somewhere in April, okay? And if indeed it gets to $18,600 profit, and it happens tomorrow, before the end of the time that the next reversal trade would happen, you get out with the $18,600 profit. That's statistically a better way to end the trade than to wait until the date of the next trade, okay? It makes more money that way, that's all. It's just been measured over the 25 years of data that most recently that's a better way to make the most money, okay? I have traded intraday for a full year in the E-minis and results aren't consistent. That's trading every day. I'm interested in your cycles philosophy to trade less with higher probability. Yeah, so the best way to trade accurately with the highest probability is to learn our forecasting course, because you really will not have the confidence to correctly assess a trade that you're in unless you have a very good handle on how long it's going to last and how big it's going to be. And mechanical systems, no matter what they are, they're oftentimes useful at getting in the market and getting out of the market, but they are trend following to some extent. They're just waiting to see what the market will give them. But if you have a roadmap of some level of accuracy, you can get into a trade with a larger amount of money, with a higher probability of winning. And even if you don't get in initially, even if you miss the initial entry and you get stopped out, you have maybe a second or a third opportunity because you've seen the pattern of the basing pattern prior to the rally or the topping pattern prior to the decline. It allows you to have much more flexibility and less attachment to this is the only time I can get in, because you have a pretty good idea of other times along the way that you may be able to get into the trade. And then oftentimes you can create a much tighter stop, okay? So we say the only thing that matters is return per year, not per day, I think. Well, that's true, except you have to be able to handle the drawdown. The drawdown is painful to the extent that some people will have a big loss and they don't want to take the next trade when they have to take the next trade in order to stay statistically in line with their system. So 2 things are necessary. One is, yes, what matters is return on the year. And of course, I don't know if you know this, but most professional traders make most of their money on 10% of their trades. The trick is not to lose much on the other 90%, because it's the over trading, and you're right about this, Roy. The over trading is the killer, and it takes a tremendous amount of discipline to not overtrade. And one of the ways you have discipline is gaining knowledge. Knowledge is the basis for the discipline, because you don't have to be very willful to have the discipline. If you know that there's a really, really good chance the market's going nowhere for the next week, you're not going to try to get into it 5 times before you finally do, right? And then, of course, Um, yeah, that's right. The trick is not to lose. You don't want to let the market take a lot of money away from you on these losing trades. And you can do that if you're not attached to the feeling that this is life and death. That if I don't get in now, I'm never going to get in. And then you hold on to losing trades way too long because you're afraid that this is the only opportunity. And once you start losing, you figure, oh, it'll come back, it'll come back. No, professionals don't do that. You just take the hit, get out, try to get back in, you know? If you can't get back in, good, you lose it, you miss it, all right? There are times you can miss a trade, but if you have the roadmap, then you don't feel that feeling of like there's no other opportunity to get in this thing because you may have 3 or 4 other low points along the way that you know are gonna happen. And the winning trades will come again. The market will give you so much profit if you don't let it, um, take your money away from you on the losers. It's a very simple thing, but it's painfully difficult to do. And this is where knowledge comes in. So the more knowledge you have, the better. The other thing is that Ikimoku technique for people who want to get in, that it's not going to catch the lowest lows and it's not going to catch the highest highs, but it gives you a pretty high probability entry that will follow through fairly immediately. And we have another system that's part of our forecasting course called the momentum balance technique, which is actually the most um, it's the least risky of all the things that you can use that we teach because you're getting into a trade with an extremely tight stop and you can measure beforehand the probable target. In other words, if you know that there's a likely target of 10 units and the risk is 1 unit, then you're likely to take the trade. If you know that there's a likely target of 1 point for a loss of 1 point, risk of 1 point, it's not as attractive. This system, the momentum balance technique, it does allow you to get a perspective in advance of what the probable risk is and the reward. And many of them, we had one recently that was about 30 to 1. And you knew in advance if it worked, it was about 70% chance of working that you would have 30 to 1 return. Okay. So you definitely would take that trade. And the stop was tight. Even if you took that, it didn't have a huge risk at the beginning. So that's the way. You need a precise entry technique. The Ikimoku provides that. This momentum balance technique provides that. Some of the short-term trading systems that we're going to present on the web, they'll provide that. But it does require precision and discipline to not let the market give you large losses. It's very difficult to make money if you're going to have huge losses. Even one huge loss in 10 trades, it can wipe out the other 9 winners. So that's the key to the game, ultimately. Any other questions, comments, thoughts? You guys are, you're on the right track here with what you're talking about. These are the important considerations. And so what's available now with the forecasting is something that it's really it's a huge advantage. I mean, it's just tremendously strong in the ability to see what's likely to happen. And you can oftentimes can find a whole path, not only the high and low points, but what's it going to do on the way up and what's it going to do on the way down. You can get in on the second or third or fourth counter trend move when you have a fairly good idea where they will be. And that kind of confidence you can't beat that. That's what allows you to make a lot of money. See, the main thing is you get in a trade, and even when you're right, you don't have the guts to hold it because you don't know how long it'll go on, right? So that could be a big problem for people, is not having the confidence to stay in winning trades long. And they have no problem staying in losing trades, So the psychology of human beings are not built to make it easy for you to make money in trading. It's exactly the opposite of what, most people consider sane. But if you're going to do it, you have to get used to the pain, as it were, of taking losses quickly and hanging on to winning trades longer than you feel comfortable if you know that the logic is and the system is telling you the market will continue to go in your direction. One of the best systems, you've heard of the turtle traders. Um, you do need to have a roadmap. Yeah, the turtle traders. It was a system created by Richard Dennis. I don't know how many years ago, maybe 20, 25 years ago, and it was a profitable system. It still exists, and I think you can even buy it now because somebody disclosed the system publicly, so he had to discontinue the program that he was doing. But almost nobody could trade it. It was incredibly painful to trade it because a lot of times you get into a position and the entry was decent. Market would go in your favor a while, it would come back, it would go up a lot, and then you weren't supposed to get out. The system didn't let you get out yet. Then it would come all the way back, and you'd have about 90% pullback of your profit, and then it would have another move up or down that was 3 times as big as the initial large profit. It ended up with a huge profit. So it had a small percentage of winners, maybe 30% or 35% winners, but the profits on the winners were so big that the system cleaned up, made a lot of money in numerous markets. Didn't work in everything, but it worked in a lot. But nobody could do it. He had 18 high school students, I think he hired, and he gave them $1 million each. There was a book called The Way of the Turtle. I think it was written by one of them guys who was one of the group. And only 2 of the 18 could actually execute the trades that the computer told them exactly what to do. They didn't have to think. They just had to follow the yellow brick road, and they couldn't do it. So trading can be psychologically incredibly difficult. People don't realize that the psychology of trading is as important as the system. The psychology of trading and the money management are the 2 things that people have overlooked and that ultimately make the difference whether you win or you lose. And if you have a good knowledge and discipline and good money management, those 3 things together, then you're in good shape. Have you tried intraday trading on the beginning of your trading career before moving forward to swing? Yeah, I still do some intraday trading from time to time because I don't like to trade every day, and I have a lot of other things that I'm doing. So if I get in the thing and I see an opportunity, I get in, I get out. Sometimes the probabilities on some of these trades are so high that it's very attractive. And the good thing about intraday trading is you don't have to worry at night about what's going on, which is now a very big deal because there's so much going on at night. There's more activity at night lately than there is during the day. But the swing trading is definitely the better way to go. I mean, you can get into positions that will yield much, much larger profits. You don't have the noise, you don't have the fees, you don't have the errors that are created one way or another, or you forget to cancel a stop, or there's so many things you can do wrong that you have to be vigilant beyond 10 times as vigilant to do the day trading. So how would it go for you? Oh yeah, at the beginning everybody loses, including me. It's just the way it works. It takes a while to get used to this, and you have to get your own rhythm. You have to get confidence. And until I met Bowring in 1987, it was like everybody else's life. It was really tough. Once I learned what Bowring had to teach, once I learned about how to do some forecasting, and I could see the history repeating, and I could see the patterns, it changed it completely. Then it becomes almost enjoyable, believe it or not. Okay. Okay. So anyway, guys, I wanted to mention this course on Sunday, the 26th. It's our newest, and it'll be going on for 3 months. The trade forecasting program, and it's 2 hours a day for the first 4 weeks, and 1 hour a day on weekends for the next 9 weeks. And these clinics have been actually more powerful than I expected because people have very good questions, and it's a time they bring their charts and their questions to me and review the issues that they have and then really integrate and learn and master the knowledge. The other thing I wanted to talk about was how we will be having this automated trading available at some point. We'll let you know when. It'll be, you should check into the website from time to time, see what's new, and probably we'll announce it there. Probably announce it on YouTube as well. And I'll continue to do my weekly S&P updates. I did one on gold, and there are some shorts now. I've been doing shorts, and the shorts are on the web on the YouTube site, but I don't think the subscribers automatically get them. So if you want to see the shorts, I mean, I called the gold, rally, and I just recently said the dollar was going to top out and start to go down for a couple of years, and also that gold is probably finished for a while. It rallied to 2000, and I think it's got a downtrend into September. It'll have another high or two, but it's not trending anymore. That high came in 132-week cycle high. We forecasted it last June, actually. So it's nice to see you guys. I thank you for being here, and have a good week. Take care.